How's it going today, team? All right, so I saw an interesting Reddit article today speaking to NAV erosion, specifically when looking at ULTY, and I wanted to do a brief discussion on NAV erosion, what it looks like, why we don't want it, and looking at that Reddit post. So let's jump right into it. Before we understand what NAV erosion is, we have to understand what NAV means. Well, NAV means the net asset value, and that truly is the total value of an ETF's or an ETP's assets minus any operating costs. So that's going to include the NAV will include the value of the stocks or the underlying asset it's holding, okay, any cash on hand it's holding, minus anything like operational costs, administrative costs, trading fees. And it's typically calculated on a daily basis. So the NAV is somewhat equivalent to a stock or ETF's price you see in the market. So generally speaking, with these ETFs, what happens, and this is true of all ETFs, when an ETF is giving out an income, is giving out a distribution, okay, it pays that income from its assets under management, from its net assets, and as a result, the NAV, the net asset value, will drop by the same amount as the income, right? And this is generally called NAV erosion, okay? NAV erosion isn't necessarily a loss, okay? It's not a loss of funds, but it is a transfer of funds from the ETF to you, the individual investor, okay? And just look at this quick example, all right? So the NAV, the net asset value before a distribution was $100 in this case, for this example. The distribution paid out was $1, all right? $1 was stripped away from the NAV, okay? And so the NAV after the distribution is $99, all right? Now the value to you as the investor is the remaining NAV, right? The N $99 plus the $1 of cash that you received as that distribution. So net, you're still at that initial total of $100, right? But the NAV is going to decline as a result of that distribution of funds. Okay. So generally speaking, if these funds never appreciate in value and they're only giving you some form of income, naturally the NAV would continue to erode. All right, and that's what's super important about the selection of funds we choose from, and why we look at market ETFs as opposed to individual stocks, is we're going to focus on market ETFs, the market itself as it relates to the S&P 500 or QQQ, or maybe international markets, to hedge ourselves to ensure that historically these things are rising, because what's going to help protect our NAV is not the income, but the growth that we have with the underlying assets alongside that income. During the intervals before the income is paid out, before the premium is paid out, these ETFs, because they generally have, let's call it weekly or monthly rolling covered calls, they have a chance to grow. They have a little bit of upside. And depending on the fund manager, every fund is a little different, but generally speaking, they get month intervals to ride some upside, and so that will help grow our NAV while the income is deteriorating the NAV. But that is okay, because, like I said, you're getting that distribution right in your hand every single month, and then our growth opportunity is going to come from those times right before the distribution, during that month period where we have those upswings, those potential upswings with an ETF, like a market ETF like QQQ or S&P 500. Another great example is this study that was found on Reddit, where if you invested in ULTY to maintain a stable $6 NAV and offset the weekly 10-cent distribution, this is how much the underlying basket of assets would need to continually increase, all right, every single week or month or 6 months. So to maintain that NAV over a 1 week period, the ULTY underlying assets would need to grow 2.78%. All right, over a month period, 11% growth. 6 month period, 100% growth, or 12-month period, 231% growth. And do we think that is sustainable? Definitely not. And I do understand that ULTY, it is about total return, and you are seeing a very sizable distribution that is covering and mitigating the NAV erosion. but we are long-term investors, guys. I don't think it's a viable long-term strategy to really race to the bottom after 1 year. Sure, if you want to test the waters here and get a bit of exposure and get a couple of yields and jump out, be my guest. But we're trying to focus on building portfolios for the future, and so that you can set it and be comfortable and sleep at night without worrying, hey, is this NAV going to destroy my yield? Am I going to get these expected payouts even at the expected distribution that the ULT has? So that's another kind of eye opener to me, that like, especially with these ETFs, these covered call ETFs that are offering such high distribution rate, there is no chance they even know it. There is no chance that they can maintain or grow the NAV unless these companies, these underlying companies, have insane growth. And so, sure, maybe MicroStrategy had a huge pop at some point, and maybe Robinhood had a huge pop at some point, and maybe Palantir had a huge pop at some point. But generally speaking, you're not going to see massive increases in stock growth in a short period of time. And as a result, you're going to suffer in terms of NAV erosion. All right. And so to illustrate why we do not like NAV decay, why we do not like NAV erosion, I wanted to look at examples from a longer standing ETF, one that's been in the market, I believe, since 2013. And that is QYLD. All right, QYLD, and that's from Global X. Over the past, look at when it's since its inception. It started in 2013. It's done negative 32% NAV erosion or price decline since inception, and it does have about a 7% total annual return out on average. But this NAV decline, what it's done to its dividends, is declined its dividends, decline the distributions generally year after year. And so if we look at the dividends here, all right, and we look at the dividend growth rate over a 10-year period, okay, or even over a 5-year period, over a 10-year period, the dividend has stayed effectively flat, okay, but over a 5-year period, the dividend has declined negative 1.3%, 1.13, and over the 3-year period, the dividend growth rate has declined negative 5.54%. All right. This year it looks like it bounced back a bit, which is okay, but we've seen quite a strong decline in that distribution rate, in that dividend growth rate over time. Not what we want to see. Not what we want to see. Yes, it has a high yield, and I understand that, but it's going to decline with the declining NAV. Compare that to SCHD, which is a more tried and true defensive value style dividend player that just holds strong underlying dividend payers. And you'll see a different story for the growth rate for an SCHD. For an SCHD, the dividend growth rate is 10.87% over a 5-year period, whereas QYLD is at negative 1.13%. So it's something to consider when investing in covered call ETFs, is looking at how these things will grow. And if you note that you might not see great dividend growth as a result of limited NAV appreciation, you get a little bit of NAV appreciation, but what you have to do, as opposed to seeing great dividend growth, is you're going to have to manufacture your dividend growth yourself by reinvesting into the fund, snowballing the impact of the asset. All right, so that's kind of a way to get more yield. And this is not true for every single fund. I'm picking on QYLD because it's a older fund. All right, others have seen good distribution and dividend growth rate, and so we want to be selective with the funds that we choose. And we want to choose ones that have NAV appreciation and a solid track record for dividend growth, or at least at this point showing a lot of NAV appreciation every single year of a bull run. Now, if we go into a bear market, all of these funds will have a NAV declining year, and that's okay. But generally speaking, if we're in a bull period, we want to see NAV growth. We want to see NAV growth. I mean, if we look at QYLD and look at its 1 year chart, it's at negative 5.44%. All right, meaning that it's distributing too much funds, and the underlying assets are not able to keep up with its high volume of distributions. The way it's set up to distribute more than it is appreciating, and that's not what we want. We want a combination of appreciation and distribution. I'm going to do more series on NAV erosion. I'm going to get more into it, and really try to explain it for you so that you can have a better understanding of what NAV erosion really is and why it is very critical when it comes to covered call funds in particular. While again, NAV erosion happens with any forms of distribution, even on an SCHD with dividends. Those, again, they're making up the difference because of earnings growth, and dividend growth. But NAV erosion will happen everywhere. But with covered calls, especially, it's going to see a more sizable impact because we're so reliant on the covered call income, the options premium, the income to pay out that yield, and all these funds are offering a very attractive high yield, and that's how they attract you. So we want to be cognizant of this. We want to understand what we're investing in and make sound decisions as a result. All right, guys, let me know in the comments below how you feel about NAV erosion. I'd love to get your opinion on that. All the best and cheers.